Good evening, everyone, and welcome to the Daily Volatility Box Report for October 1st, 2019. We are TOSindicators.com, home of the Volatility Box. I'm going to try and keep today's video a little shorter just to preserve my voice, but also we'll look at the charts a little bit differently today. So across the board, also just fair disclosure, I was not able to take this crude trade because that's when I was on that Mr. Top Step presentation mode. But we did have one of our subscribers, Paul, who was in the Mr. Top Step open house, who called out that he took this trade. So awesome, Paul. Once again, thank you to all those that joined. Paul, Andrea, I know you two were there for sure. Anyone else who was silent but in the audience, thank you. Really appreciate your support. But with that, let's actually now take a look at what happened today. So across the board, when we had the PMI numbers hit, we had trades set up using the conservative volatility box. I'll talk about why the conservative in just a second. But despite that, even the conservatives were all stop outs. And again, to us, this is just information. So yes, this is, an actual loss, so on and so forth. But as soon as you can start to change your frame of mind from that, okay, yes, you got stopped out, but what does that mean now? And what signals does that give you? I think that really starts to change the way you approach trading. And so, Steve, if you're watching this, we used your observation to actually then start to inform us for trades in which we could then start to play the S&P, the NASDAQ, the Dow, the Russell, and the bonds using each of their equivalent options. And so I know a few of you have asked us which ETF options we like to use. So for the S&P, that's the SPY. Prefer the SPY over the SPX. For the NASDAQ, the Qs, the Dow, the DIA, the Russell, the IWM, and then for the 30 years, we use the TLTs, all of which, the TLTs are super liquid in my opinion, and so I really enjoy trading them. They're a better way to essentially have a defined risk trade when you don't have the ability to, say, get into the micros. And even with the micros, we've noticed some of those funny wicks happen, especially when volatility starts to pick up. So the ETFs really just protect you to a certain regard. You obviously don't get the same sort of pricing structure or anything of that sort, but in my opinion, that's just a trade-off that you need to consider. So with the official fading edge trades today, with the volatility box, there were 6 trades total. Only one of those 6 was a winner, and that crude, for a total loss of 28.05. However, if you've been listening to yesterday's video, or I think the videos last week in which we talked about TLT as well, then you were able to sort of see this pattern unfold and maybe take advantage of it, or at the very least, you knew what to sort of expect given the price action. So without further ado, let's dive into charts. Okay, so we'll use our grid format. And so first we'll start by talking about why conservative volatility box, right? You'll notice that we're on the conservative on the S&P, the NASDAQ, the Dow today, the Russell. Crude was on the aggressive because nothing, we didn't really have the type of reaction on crude that we did on any of the indices. And then bonds, obviously conservative as well. So now, the reason it's conservative, first of all, is the PMI number that came out. So this is an actual news event. It's not like last week where, for example, I think it was the U.S. is weighing, imposing, or portfolio limits into portfolio flows into China. Sorry. It wasn't a news event like that, right? This is a pure statistic. It's an actual number. It's a number that was published. It was a number that's less than 50, and it's a number that just on an objective scale, it's a binary decision, yes or no. On that binary scale or tree tells us that yes, the economy is in fact stagnating, or at least that's what that number symbolizes, that it's slowing down. I think it was the lowest manufacturing number that we've seen in quite some time. And so this is just a statement of fact, right? And so we tried to fade that reaction because that's what our rules tell us to do, right? It's not my job to try and sit here and guess how the market's going to react to at least this number in particular. But it's a more serious number than, say, like a news event or something in which we really just see that spike and we get that continuation up. But now let's say that you did not get that fundamental part of this conversation, right? Let's just see what price action was actually telling us, given the patterns that we've already been talking about. And so I'm going to use the grid format because I think you can all zoom into the charts if you need. But for each of these indices, our trades were right at the entry line, right across the board. The Dow is the one to get whacked the first, and I use the word whack in a very loving manner. Let me change this. All right, so the Russell, also same thing, entry line right there. Crude, our one entry was into, I think, almost the final hour of the market. at 11 o'clock, and then you had a follow through. You didn't quite get what you were looking for, which was 30 cents, which is your stop outside of the volatility box. But you did get to 16 towards the close, 16, 17, and then you stagnated. And so that's where I think had we been in this trade, we would have taken it off. But now let's go back to the bonds. And so the bonds, the entry was right here. Okay, so I've purposely left these, 5 circles on the charts, right? And now we'll draw their equivalent stops. And so we'll just eyeball this. But on the S&P, that was 7.5, our stop. On the NASDAQ, it was 25. On the Dow, we had a 65-point stop. And on the Russell, we had a 4.5 stop. And the bonds was 8 points, right? And so we see how quickly after this circle, we ended up, the price hit that, the arrow essentially stopped us out before we had a bounce. In fact, the NASDAQ was the one that was closest to giving us a bounce. Our target was at 25. We got to 21.5. And so again, not something we adjust because it's just one of those things where it's so much clearer looking back. And it's easy to say that, yes, you may have wanted to trail your stop, at least in this case, before you hit your T1. But so for us, that was all of these were stop outs. But now once we stop out, this starts to give us information. It tells us that price is breaking past even 3 standard deviation territory, especially in the case of the Dow, right? I'll perform one more exercise at the end of this in which you should be able to tell just by looking at this which indice was hit the most, and then you think about it a little logically, and it kind of makes sense. The Russell, also same thing. We stopped out. 3 standard deviation territory. And the bonds, this happened almost just instantly. And as per the observation that Steve, you had talked about, and I think we talked about this even in the open house today, this is now your sign that tells you that you expect price to be trending in one direction heavily, even if it is for just that next hour, right? So if you remember, I think it was in the case of gold yesterday, that's where we had only a little bit of follow through, but that little bit of follow through still represented a 25% gain in your options and was exactly where you'd be peeling off at least your first batch of contracts before your stops move to break even. And that's what you had an opportunity to do today as well. So on any little pullbacks, essentially just so that you are, and even if you wanted to buy an option as soon as your position reverses, right? Timing is one of those arts that you won't be able to do. Obviously, you might get a little bit better pricing, and that one pattern that we talked about is switching on over to the aggressive volatility box, right? And so those entry lines can also start to act as means of pullbacks. You could just buy scale into your contracts essentially after you start to break. But really, this is a sign, and that's all I'm trying to point out right now is this is a sign that price is probably heavily trending in one direction, and as per our rules now, you would not be looking at fades, but really just be looking at trades in the same direction, right? And so really both to say you are now having a directional bias. And so on the S&P's case, our directional bias was to the downside. On the NASDAQ, our directional bias was to the downside. On the Dow, same thing. Same thing on the Russell. And on the bonds, we had a bullish directional bias. And if I pull up the chart for gold, you'll see the same thing, right? Also a bullish directional bias as we blow through. And yes, we're only looking at a 6 to 7, but the rest of the time it still does give us information. And so that's I think the point to take away is yes, we had losses on those, but we flipped over and just ended up buying some options, and this was a nice ride to go down lower. But that's another idea that you can start to play with. It is a little bit more aggressive for the aggressive trader, but we've seen this pattern start to play out a lot more often, and it makes sense if you just kind of think about it logically. It's okay if price is doing something that it doesn't typically do, it's not doing what it should do. That's information in itself, which then tells me that okay, price is, in my opinion, I now can develop a bias for price, which I normally don't do, right? Where we don't try to guess, but unless we're given signals or signs otherwise. And so hopefully this video just gives you a little bit of an example of how the volatility box is more than just something that helps you fade edges. It gives you information, especially on days like today. And one more thing just to point out, we said this. So now if you look at all of these indices, and this makes sense now that you maybe think about it. Maybe it made sense in the moment, but it's one of those very clear things. You can very easily tell that the Dow is the most volatile out of all 4 of these indexes, and you can also see that the S&P was getting dragged down by the Dow, while the NASDAQ survived a little bit longer before that eventual push down, and the Russell, same sort of thing as the S&P, right? Very similar action. But just like that, at a glance, you can start to rank each of these indices in your head in terms of the volatility that they're currently experiencing with regards to what they typically experience. All right, so this video went on a little longer than we thought, but hopefully you got some good information out of it. If you have any questions, feel free to email us at contact@tosindicators.com. All right, take care, everyone, and I'll see you in tomorrow's video.